Not a surprise that the NASDAQ, I guess, is leading. What do you do when you're a little uncertain or bullish on AI? You buy tech.
You run
buy
back
the
to your old
NASDAQ,
fling.
unless your name is Jenny Harrington.
Right.
Then you buy Whirlpool. Or you buy Stanley Black & Decker.
Right.
And these are your two newest moves that you wanted to share with us and our viewers today. Let's go Whirlpool first, and then we can discuss.
Okay. So I think it was interesting. Do you remember about a month ago, Goldman upgraded Whirlpool, and I had a small meltdown because I said, I've been working on this. I've been so close to buying it. They put out a really compelling bull case on it. But so what you have for both of these actually is a similar investment backdrop where they've got easing supply chain issues. They've got freight costs coming down. Inventories have been worked out, but most importantly, the share prices have dramatically corrected. Whirlpool's down 50% from its all-time high, which was in 2021. Stanley's down 62%. So you have this company, Whirlpool specifically, where they're going to earn about $16 a share this year. They've got a 5.4% dividend yield, and the shares are trading at the same price they were at in 2013 when they were only earning $10 a share. And this really speaks to the market, right? It is a mixed up, bifurcated market where within sectors, within strategies, different stocks, everything's moving differently. And I don't want to buy something. I'm much more comfortable buying this at 8 times. With this big yield and this low valuation, earnings growth ahead as things normalize, than I am buying something that's already up a lot this year.
You're comfortable buying something where big ticket item demand remains, I think, a serious question. And we've heard it from CEOs who are selling big ticket items.
So I think in this space, it's a little different because there's a less discretionary component to if your dishwasher breaks or your washing machine breaks, you have to buy that. So that's different than like kicking the can down the road, or rather saying like, hey, I just want a new car because I want a new car. People don't go out and they're like, hey, I just want a new dishwasher. That'll be fun. So there's a different element to discretionary on Whirlpool than there is otherwise. The other thing is they had this earnings call, and what you really saw in the earnings call is that demand is stabilizing. It's getting back to normal, where it's not through the roof. And it was wild during the pandemic when you saw the share price just shoot up because it was like, oh, everyone's going to own a home. Everyone's going to need a new washer. That was irrational.
Okay, so Stanley Black & Decker, why that one? Aside from the 4% yield, which is the attraction, I'm sure, but why?
Well, here you have a dividend aristocrat that's paid and raised its dividend for 55 years. I have never been able to touch this company. And here you saw the same thing, a massive run up with pull forward in 2020 and 2021. And then the share prices, I think, have dramatically overcorrected. And they have over-expected a bad recession, a horrible consumer. But the reality is a lot of their business is done by contractors, and work just continues. Even though we have really, really low new mortgage rates, low housing inventory, low housing turnover, work still needs to be done on homes. Like I have a DeWalt drill and the batteries were dead, and I had to go online on Amazon the other day and buy new batteries. That was like $130. But you can't get around without your drill. You just need these products. And so yeah, I think they've overly corrected.
Can you buy these stocks if you think there's going to be a more dramatic economic slowdown? Because I would suggest that you can't. And this must be representative of your view that you are more optimistic about the trajectory of the economy than others.
I don't think that's true. I think it's my view that these have already overcorrected and accounted for a worse recession and a worse consumer than we're likely to actually get. Because I do expect that we're going to enter recession. I don't think it's going to be terrible. I think the whole rolling idea, the whole divergence between sector and strategy, has softened what we're going to get when we get the recession collectively. But I do expect that, and I bought them now because I don't think I'm going to get another chance.
Wow. Okay. So these particular stocks, then, in at least your mind, have priced in.
That's what I think.
A recession, that's a controversial take in and of itself. What do you say?
Yeah. Well, I mean, I love these picks, but I want to address the recession call, because let's just say we know my base case is that we skirt out without a recession, but most people who are calling for a recession are calling for a short, shallow one, right? One that we're out of in the first quarter of 2024. We know the market looks forward, and here we are in May, soon to be June. I mean, the market is going to start looking forward to 2024. Now, this is not just a theoretical construct I'm coming up with. I think if you you look at Home Depot, which obviously applies to Whirlpool and to Stanley Black & Decker, you see that was a terrible report. Like, I'm not sure I can say enough bad things about how that report was 2 days ago, and yet the stock's up 2% from there. It's not on the back of that report, and it's not on the back of guidance. I think it's on the back of, hey, if you do get a recession, it's going to be over by the first quarter of 2024, and housing's going to be growing again.
See, the other